Welcome to USMK Insights, where we focus on US stock technical analysis. Using charts, trends, and price action will help you understand the market rhythm and make informed buy and sell decisions. Alright, hit subscribe and let's begin today's learning journey. Hello everyone. Today let's talk about how to use trading volume. Volume reflects the supply and demand in the market. It shows how active a stock is. It refers to the number of shares traded within a specific period. When the demand exceeds supply, buyers rushing and volume increases. A surge in buying naturally boosts the volume. On the flip side, if supply outweighs demand, the market becomes quiet and buyers fade. As a result, volume shrinks. So trading volume is a numerical reflection of market participation. Broadly speaking, volume refers to shares or dollar value traded. This includes total turnover. In a narrow sense, it usually means the number of shares traded. Volume helps measure buying and selling pressure. It reflects bullish or bearish sentiment, and it confirms price movements. That's why smart investors always track stocks that show volume spikes at the bottom. Because when the stock supply demand dynamics change dramatically, price movement usually follows. So you should never ignore the relationship between price and volume. When price and volume align, the stock often rallies sharply, just as expected. Today, we will use a real example to explain this concept and how to apply volume effectively. Because volume means different things at different price levels, its interpretation depends on where it appears on the chart. For example, when volume spikes at a high level, it could indicate distribution. Smart money is selling off, sign that the stock may be topping out. But when volume rises steadily at low levels, it often signals institutional buying. That builds a strong foundation for a potential uptrend. It helps fuel a price breakout. So volume has different meanings depending on its position. We need to read it carefully. First, look at a low price setup. In this range, the stock was consolidating on low volume. Then suddenly volume surged and price broke out. We see a breakout with rising volume. At this stage, price rallies sharply along with the volume surge. That indicates large funds are entering. Smart money is accumulating shares and driving price up. That marks the first phase of institutional positioning. And since this happens at low levels, we don't need to be overly cautious when volume expands. So we can clearly see the price rises as volume increases. That's a healthy market behavior. Volume rising with price confirms upward momentum. This is a bullish volume price relationship, and it signals that price is likely to keep rising. In uptrends, the pattern often appears. Volume increases and price follows. That's the first key use of volume. The second pattern is price rising on strong volume, followed by pullback in price, while volume decreases. This phase is typically considered a shakeout or consolidation. Here, price retreats slightly along with lower trading volume. This type of pullback on light volume is common and healthy. Volume declines as the price pulls back or consolidates. This behavior is generally viewed as a normal correction. So when volume rises and price goes up, and then volume drops as price pulls back, it signals that large institutional buyers were aggressively accumulating in that earlier zone. They pushed the price higher but didn't exit near the highs. There was no sign of distribution. So during the pullback, volume declines, not expands. If volume had increased on the pullback, then that would be a red flag. You'd have to question whether the big players were starting to sell. It could suggest institutional unloading had begun. When volume dries up significantly, let's say it drops to half or even a third of the peak, that means earlier institutional buyers don't have the opportunity or liquidity to sell. The volume is too low for them to exit their positions. There is simply not enough demand to absorb it, so they stay in. And because they're still in, that sets the stage for the next leg higher. If the smart money had already exited, why would price continue to rise? So that's something to think about. It's a volume contraction during a pullback. That signals institutions are still holding their positions, and that opens the door for the next wave up. That's when we want to be ready to enter on the next breakout and capture the strong upside that follows. Now, the third point, when price breaks above or below a key resistance or support level, it must be confirmed by a surge in volume. What does that mean? Let's take a look at this chart. As you can see, when price breaks through a previous resistance level, volume starts to increase. Then on the next breakout, volume increases even more. You see that surge? And notice volume keeps expanding. So what does that mean? It shows new capital is flowing in, driving prices higher. This is a clear sign of strong bullish momentum, the bulls overpowering the bears. That's why a volume surge on a breakout confirms a valid move. It's one of the most reliable signs of a genuine breakout. Some people say a breakout needs 3 days to confirm its validity, but if there's strong volume on the breakout day itself, especially when breaking through a key resistance level, we can often judge right away that this breakout likely signals a new trend and that the breakout is valid. Same thing here. Look at this area. You can see the price approaching resistance again. Did volume expand at that level? Was there a volume surge here? Yes, it broke above the resistance with a strong gap up on volume. That's a textbook breakout with confirmation. Now look at the volume. It's clear and obvious. Volume spiked. That's the power of confirmation. Whether it's an upside or downside breakout, both scenarios often come with a volume surge, and that surge usually signals that institutional money, big capital, is driving the move. All we need to do is to follow their lead. All right, that's the third scenario. Now let's move on to the fourth point. When the price rises but volume diverges, this signals that the price increase is not being supported by the institutional buying. Instead, the rise may be driven by short covering. So what does this mean? In simple terms, not all price increases are fueled by bullish demand. The rally in price might not be the result of aggressive buying by bulls. It may instead be caused by bears closing their positions due to losses, either from stop losses being triggered or forced liquidation. That short covering action pushes prices up temporarily. As we can see here, the price keeps climbing steadily, making new highs along the way. However, volume is not making new highs, so the price and the volume are diverging. When the two don't align, what does that indicate? It means there's a divergence between price and volume. This could mean short sellers are covering, pushing prices upward, but it might also reflect weakening bullish momentum. When buying power weakens and buyers show less conviction, this divergence signals exhaustion in the trend. At this point, there's a real risk that bullish strength is fading and a potential reversal to the downside may follow. This sets the stage for a possible trend shift. So when you observe a rally where price is moving higher but volume fails to break above previous highs and is lower than earlier volume spikes, that's your warning sign. It suggests that bullish momentum is weakening. While the price trend may still be up, the buying pressure behind that uptrend is fading. Take a look here. Compare this rally with the previous one. You will see a clear slowdown in momentum. This is a choppy uptrend, whereas before we had a sharp continuous surge. The upward force is weakening, so you need to be cautious here. When price rises without corresponding volume, it's often a sign that the bulls are running out of steam, struggling to push higher. The momentum simply isn't there. So when you're trading in this kind of situation and you see this pattern unfold, it's time to begin gradually scaling out of your position. Let's say you bought in near the bottom. As the pattern develops and you start to see clear signs of reversal or pullback, that's your cue to start locking in profits. Alright, that's a fourth pattern. Now let's look at the fifth scenario. After a period of sustained price increase, you suddenly see a large volume bearish candlestick appear. At this point, there's a high probability that a short-term top has formed. We should immediately take profits and reduce our positions. What does that mean exactly? Let's take a look. A lot of people ask, why did the price pull back here but still continue upward afterward? It's because the previous rally was supported by high volume. Here, during the pullback, what about the volume? Look at this. Was the volume higher than the previous 2 days? No, it was lower. This was a low volume pullback, right? But now look here. After a strong upward move, what do we see? Price continues to climb steadily with moderate volume. Then suddenly 1 or 2 days of sharp reversals with heavy volume, big spike in volume, and that surge in volume was even higher than the entire uptrend before it. That's key. During the uptrend, the volume was here. But on the reversal day, volume spiked dramatically. That's a strong sign of the short-term top. There's a high probability of reversal here. So in this scenario, you must be cautious. Start reducing your short-term positions immediately. So these are 5 different price zones, including low volume accumulation, rallies, shakeouts, and distribution phases, where volume patterns shift significantly. A volume surge at the top is usually a signal of distribution, but when you see strong volume at the bottom, that's generally a healthy sign. It means institutions are building positions and absorbing shares, right? So the significance of volume changes depends heavily on price level. Each pattern reflects something different. For instance, if volume dries up near a peak during sideways movement, it may indicate rotation or it could be a consolidation phase, setting up for another leg higher. But if you suddenly see a huge volume spike, be careful. On the other hand, if volume stays low, you can just observe without much worry. It's not a major concern. That covers volume behavior during an uptrend. Now let's take a look at how volume behaves in a downtrend. During the early stages of a downtrend, volume typically remains elevated. Why? Because institutional investors are unloading shares quickly. There's heavy selling and distribution. Selling pressure dominates. Then, as the trend progresses, volume gradually starts to dry up. That's because institutions have already exited. They have finished selling, and what follows is a slow grind lower with fading volume. Price keeps declining gradually. So, if you are thinking about bottom fishing here, it may prove difficult. So, when is the right time to bottom fish? It comes back to what we discussed earlier. Watch for volume increases at support, especially at lower price levels during pullbacks. Look at this area. Volume picks up, right? It's noticeably higher than before. Here again, we see a surge in volume, very similar to the previous spike. For example, if price drops to a relatively low level and then there's a large volume breakout at support, that usually signals new institutional buying, big money entering the market. They are buying the dip. So when you see heavy volume at the bottom, it supports the case for a short-term rebound. Now let's look at this section. Here, a double bottom or even triple bottom has started to form. Then we see increasing volume and price stabilizing. Once it finds support, the price begins to climb, right? This is a textbook example. Heavy volume at the bottom signals that major players are buying in. They accumulate while shaking out weak hands. Then the price breaks out again. This setup mirrors what happened earlier in the chart. It looks very familiar. The same pattern plays out, right? So always pay attention to volume. It helps confirm what's happening. It reveals the intention of institutional capital, whether bulls or bears have the upper hand, and the shift in sentiment between the two sides. It's a key way to measure market strength, the conviction behind buying and selling, and the broader market sentiment. Alright, that wraps up today's session. Thank you all for watching. See you again tomorrow.